Good day, all. Ira Epstein of Linn and Associates with your metals market wrap-up for this Thursday. And we are now at the 10th of October 2019, right after 4:30 p.m. Central Daylight Time. My brain's going faster than my tongue right now because I'm trying to figure out what to say and how to say it. We still don't know where we're at on the U.S.-Chinese trade talks. Yes, it sounds promising because I think he's got Nui Ha or He is stayed here, the vice premier of China. He's due to meet with the president tomorrow. I can't in my wildest dream think that he's going over to the White House to stay in America, go to the White House and say we don't have a deal. Now, that doesn't mean I'm right. The question is, what kind of deal are we getting if there's one on the table? If you're telling me that the tariffs stay in place, if you're telling me that there is a pause, are they being removed is what the market would want to see. If you remove the tariffs, that's a different game. That could be the liftoff in the stock markets. And the question is, what does it do for the metal markets? Because that's what we're talking about. Well, the metals are looking at a negative reaction. Those that were buying because there might not be a Chinese trade deal, they saw the market fall in the silver and the gold. Let's call that the precious side of the market, even though I don't think silver is a precious metal. And we saw the copper up, the platinum up, the palladium. So those parts of the market did well, the industrial side. But it's too soon to know. We don't know what we're dealing with. The dollar market came down to key numbers. I still think 98.30, and you'll see that in a moment here, is very important. And as expected, the euro, if you have a deal, because their economy is export-based, got a bit of a bid here. So let's go to the gold and see if there's any damage. Well, certainly, we've been in a down thrust. That's nothing new. We're still about, what are we now? $32 away from the highest close we've recently had. Let's assume the market wants to continue down and go back to what I call the line in the sand. You've still got the 1462 level in play. If you take a look at a daily bar chart, for those of you that get my written reports, I've been talking about the 1515 and then the 1525 level, this high right here. And as you can see, 1525.80 was not taken out. You got as high as 1522.30. You've created an outside day down. What would turn this chart suddenly bullish and reverse things? Got an idea? I say if you take out the high of an outside day down, within 2 trading sessions of it being made, you create a bear trap for that. Now the question is, where might it go? So first, let's put on moving averages. And as you can see, this market has been stuck now for 1, 2, 3, 4, 5, 6, 7, a week and a half of trading week and a half of the market just being stuck against this 18-day average of closes. It resolved itself to 2 levels. Number one, you've turned the swing line down because of the outside day, and you did turn the bias down. Where's the resistance and support levels? Since you're trading against the 18-day average, to me the resistance is the upper Bollinger Band and supports the lower band. Could you go down to the 100-day average? You could, and that's going to climb at the end of this week because of how the settlement prices have gone, and we're going to drop some of the 18-day data here. It's not going to go very much, though. I've already looked back to see what 18 weeks, or days rather, worth of data look like. Momentum, I have no clue. It's just drifting sideways. So what we have here is a market that is drifting in momentum. Prices are drifting back and forth against the 18-day average, and you're caught in sideways action of the Bollinger Bands. When we come to GLD, as I'm looking for a clue, the market, and let's go back here just one day and then come here. I want to take you here. This is how we looked yesterday. And yesterday, the market had a pattern of higher lows, and we'd already had higher highs. Like the futures, you've been fighting against this 18-day average of closes. To me, the worst event that would have happened was taking out 140.24. Well, the market didn't do that, but it also got back under the 18-day average, neutralizing that bullish bias that it had. Now, if we look at the high of yesterday, 142.58, and we come back here to this high, 143.25. then you got to ask yourself the what if possibility. What if the market gives up the pattern of higher lows and suddenly, and by the way, it's given up a certain degree because you got lower highs, as I just showed you. If you take out 140.24, you actually turn the trend down. You'd have lower highs, take out that low, lower lows, you're putting into play then the 139 level, and if that were to give ground, I look back here. Conversely, don't take that out, get over 142.58, and then the upper Bollinger Band comes in play. In GDX, the market finished 28.05, literally right up and over the 18-day average. So the pattern is still higher lows, higher highs, bullish bias. Support, if you were to come down hard, would be the 26.55 to 57 level. The uptrend gets broken but doesn't turn into a downtrend if prices take out 27.14, and you get an accelerator base to the upside if the market can take out 28.38, as the market would then, ideally, you'd want it to close over the 18-day average, over that high, and all of a sudden traders would get friendly this market, giving you both sides of the picture. The gold-silver ratio refuses to get back under that 18-day average of closes, so the bias still favors the gold market over silver. And as you can see, silver is caught here in a battleground of the 18-day average now for the past 3 trading sessions. The pattern is one of a lower low. It doesn't look like that, but this low of 1730 and a half is lower than 1733 over here. And you've got the higher high. No trend. Momentum going sideways, stuck against this average. So let's assume you break through 1730 and a half. Well, you'd still have the higher high, lower low, but you'd put into play the 1700 level on the lower Bollinger Band. Let's flip it around. Let's assume the market decides, hey, we have a trade deal, it's bullish silver. I have no idea. If you get over the 1800 level and don't take out this 1730 and a half, what happens is the market goes back into its uptrend. Then you have higher lows, higher highs. Over this number, you're putting into play that 1860 level. That's how I'm reading today's action. In the copper market, with the big outside day up, notice how close it got again to that Bollinger Band. Pretty close to my theories that the first time you hit these numbers, you got to be careful. I think the shorts are coming out. Now the market's got an uptrend. Higher lows, higher highs. Very stiff resistance against the 100-day average in the upper Bollinger Band. But you're going into a report. I call it a major report when we're going to get word on how this trade talk is going. And if they resolve anything, what is it that they're resolving? We've been in this for a year and a half. To just say they're going to buy some grain from us and they're going to do something on the currency similar to what we did with Mexico, that's what we fought for. I don't know what's going to happen here. Very dangerous situation. In the platinum, you came out of the downtrend. Now, as you can see right here, with this pattern, the market had both numbers over 80, both under 80, both under 80. So we had 3 days, 4 days in a row, 5 days. You had an embedded reading that got there. What I say is if you lose the embedded reading, unless you get it back the very next day, and I mean quickly, the odds favor price and the 18-day average coming together because this downtrend ended. And I say this downtrend ended, remember what we talked yesterday, if you took out that high and you did it, you'd have to get something bad. Now, if that bad happens, support's 969 to 963. If the good happens and you stay lost and the industrial metals pick up, 920, even though I don't think platinum and palladium are necessarily industrial metals at these prices. I don't know why people think that. You got a lower low, higher high in the palladium, overbought, big time resistance right here at the upper Bollinger Band. And as I said in the dollar index, you've got a higher low, lower highs, and you forget today's action. You had that anyways. The 18-day average, that line in the sand, is what I look for the market to decide what to do. Let's assume it gets under 98.30. Momentum's already down. Bias is down, then the trend would be down. Are we putting in the play coming back to the lower Bollinger Band? What do the bulls have to do to keep the pattern? They can't let it get under 98.30. If they do, no matter what they do, they'd have a lower low, and even if they rallied, a higher high. Got it? This I talk about, and our staff does, is we get into our research from Linn. Now, Linn doesn't cover my own research, but they certainly cover their own in the terms of they cover the metals, they're covering the financial markets. You get emails dropped right into your email box, or if you have our financial software or our grain software, whatever it is, our charts, let's call it that, you get a lot of data. Some of you like David Hightower. He's in this, so his broadcast, I think 4 times a day they're broadcasting through this. Now you'll say, I'm not listening to it at that time. Won't matter. All of our broadcasts are kept right in the charting software. Just go to the media part and it'll play right back for you to tell you the time they did it, and then you're listening. It's a great way to catch up with the markets. So how do you get at this to get some access to it? It's simple. Just call my staff at 866-973-2077. Go to our website, www.iraepstein.com, or you can even click up here and you'll see free offers. Go there, sign up. I'm Ira Epstein. You have a good